Right. Hope I'm audible. Am I audible?
Yes, sir. Audible.
Yes, sir.
Good. So the last week we have finished topic number 4. Today we are going to move to a new topic. That is topic number 5. Let me share the screen first. Right. I think the screen is visible. Topic number 5. So here we are discussing a new topic. So we are now discussing individual risk types. So we discussed the credit risk previously. Now we are going to discuss market risk. So weightage for the exam is 15%. Right? Weightage for the exam is 15%. So this is one of the key risks that we need to discuss. And this topic also has some additional areas from statistics. So it's a bit of a lengthy topic again. So let's see whether we can complete within the day, depending on how it goes. Right. So when you talk about market risk, when you say risk, there's something unfavorable, right? There's something not good, something that affects the organization. That's what we generally look at. So with regard to the market risk, the main area we are touching is the price uncertainty of an instrument or an asset. It's about price, the volatility of price. This market prices of the securities, the market prices of the assets that the bank or the institution holding can vary in different directions. If it moves into an adverse direction, it can create a loss to the organization. So that risk of loss to the organization stemming from that price volatility is called the market risk. That is the general meaning or the idea. So we will discuss a definition later. So remember, as we always discuss, risk is something in the future, right? That is why it is uncertain. But we have no control over what is happening in the future. We don't know what's happening in the future. So that's why it's uncertain. So we're looking at something uncertain in the future in terms of price, and that creates the market risk. So the definition as per the textbook is the risk of loss arising from changes in the value of financial instruments. Now, the term financial instrument is a broader term that captures any instrument that is designated in financial terms. You can hold positions in financial instruments. It can be a physical asset or a commodity, or it can be an intangible, right? Maybe a right or a financial instruments like investments, shares, right? All that is coming under this. Right. When we discuss this market risk or the price volatility, it has subcomponents or types. There are different types of market risk. Right? Different types of market risk. As you can see, there are 7 types as per the textbooks. Volatility risk, market liquidity risk, currency risk, basis risk, interest rate risk, commodity price risk, equity price risk. Right. Let's take one by one. Volatility. So this is where the prices of your instrument, whatever you hold, moves fast up and down. Because the prices are not very stable, it can move up and down due to market mechanism. And then when you are unable to predict the price movements, when you are unable to identify the speed at which the prices are moving, then it creates a risk. Then it's uncertain, it's a risk. So that is one thing. So this will have an impact on the pricing. So this volatility of prices have an impact on whatever the price that you're going to realize the asset. As a result, you sometimes have to sell the asset at a lower price than what you purchased, resulting in a loss. Now, options. Here, that's an example. This particularly affects options pricing. How many of you are familiar with the term option? How many of you are familiar? You can raise your hand or you can say yes. What's an option? So these are not very much familiar in the Sri Lankan context. Any idea? Option? No one knows what options are?
So options are a certain type of a derivative.
Hmm.
There are put options, call options, and there are certain regulations involved. And I think it's not OTC. It is a kind of a derivative instrument.
Yeah. What's your role?
I'm the assistant manager, market risk at Sampath Bank.
All right. Okay. Good. But you're not dealing with options, right?
No, in Sri Lanka, actually, we do not have.
Yeah. That's what I'm asking. So, but I mean, the reason I asked you, you're knowledgeable. You have studied this, no?
Yeah, in theory, yes. In theory.
Thanks. Okay, because this financial market is not that developed in the Sri Lankan context, maybe it's in the Asian market also. But India is well ahead of us in terms of some of these complex instruments because they also have the publicly trading derivatives in their market. In the Western world, you can find all these things, right? So they say the derivative market is the largest market in the financial market, if you look at, right? Because that's so big. You have hedge funds, mutual funds, and all those funds operate. So for some of these funds, right, it's like what we have in Sri Lanka, this Namal and all this, there are places where you can go and invest in a fund so that they will in turn invest your money in other instruments. So they maintain private funds, equity funds or fixed income securities, whatever. Some of those funds in the US market, if you say, your entry criteria for you to enter, the minimum investment might be somewhere like $1 million, right? Some are even $10 million. So very big. But the Sri Lankan market, we don't see. So, okay, let's get back to the topic. So option is a derivative. So derivative is a financial instrument, the value of which is dependent on the price movement of another underlying asset. That means the derivative doesn't have its independent existence. It has to be always matched with the underlying asset. So the best example I can give you is the vehicle permit. If you take a vehicle permit, a permit cannot have an existence without it being attached to a vehicle, right? So depending on the price movement of the vehicle and depending on the tax advantage, the price of the permit can vary. So the price of the permit is derived from the price volatility of the vehicle and the tax advantage you get. So it's something like that. So option, when you purchase shares, let's say you purchase use the screen, right? Let's say you purchase a share from company X, the share market for 100 rupees. And you have a risk of this price going down. Say, for example, if the price is up, you're safe, right? Later when you want to sell it. But when you want to sell it, if the price is lower, you have a risk. So what you can do is you can go to the market, derivative market, and buy an option. Options have two types, right? Put option, call option. Put option gives you the entitlement to sell an instrument at a given price. Call option gives you the entitlement to purchase an instrument at a given price, right? So in this case, you have already purchased this share. You need a mechanism to sell this at a particular price in the market. Let's say you purchase a put option that will allow you to sell these shares at 120 at a later date. So that means this option gives you that entitlement or the right. So let's say after 3 months time or whatever the time lap, you want to sell this and you go to the market and you see the market price of this share is 90. That is what the market is willing to pay you. But now that you have a put option which has given you the entitlement to sell it at 120, you can bypass the market price and you can sell it at 120 and take a gain of 20. Because this put option gives you that entitlement. But your gain is not 20 alone because you have to pay a price to purchase the put option from the market. Probably the price of the put option in the market could be, let's say, 5. You have to pay 5 rupees to get or purchase the put option. So you have purchased put option with the 5 rupees. You have made a gain of 20. So your net gain is 15 out of this deal. If you didn't purchase this put option, you will run into a loss of 10 because the market price is 90. Got it? So that is a put option. Same way, the call option gives you the entitlement to purchase shares. Let's say you want to, you have also taken a call option that will allow you to purchase shares at 100. Then, although the market price is 120, you can use the call option and purchase at 100 rupees. You have a gain there. You can use the call option, purchase shares at 100 and sell it in the market at 120 and gain. Right? You can do that as well. That is how the option market operates. Now, the point in the slide was, when the prices are moving, the option prices are moving faster because uncertainty all over, right? So there's a complex mechanism in determining the prices of these options because these are very volatile and there are certain techniques. We don't need to know all this, but the idea is this is how options operate in the market. I hope it's clear. Right, let's get back. That's why it says this volatility risk is affecting the options pricing. When the share market is volatile, it can be share market or bond market, whatever the market, right? When the market is volatile, then the option price can vary faster. Right. Then you have market liquidity risk. This liquidity is not the typical liquidity that we discuss. In a typical setup, or the definition of liquidity is availability of cash and convertibility of other assets into cash. That's what we generally look at as liquidity. But here, in this case, market liquidity means availability of sufficient level of trade, right? So when you have enough trades happening, that means there's demand and supply in the markets. So the trades are taking place frequently at a reasonable volume. That means whenever you want to sell your asset or your share in the market, it makes easy for you to trade it because there's trading taking place. But when the market is dull, only a handful of transactions are taken place, right? Or maybe for certain assets or certain shares, no demand at all. So when you have that kind of situation, you are unable to sell your asset in the market. As a result, you may run into losses because your cash is stuck in the asset, and then you will have to incur additional cost because your cash flow needs you will have to fulfill with other means in that case, right? So it says this happens when there's lack of demand and supply, or lack of market makers. So there are people, brokers, or the intermediaries who create markets, who influence and induce market activity. So when those people or the interventions are not there, there is no trading happening. So that will affect this. That is the market liquidity risk, right? Now here, this example is liquidity for a physical asset. An investor purchases a commercial property to rent out because the liquidity issues in the property market, it takes much longer to sell again, right? But the problem is, even if you reduce the price, there's no market for it, right? It's not a question of price now. It's a question of not having buyers to materialize your transaction, right? Dull, no activity. That's why we use this term liquid. When the share market is very active, a lot of trades being taken place, then we say share market is liquid, right? Because there's a lot of activity. So this is the same thing here. Next one is currency risk. So currency risk is relevant for a particular instrument or an asset when you have foreign exchange involvement. Foreign exchange involvement. Sometimes you may purchase an asset for a particular currency, and then when you deal with this, when you sell it, you may have to convert. If you have invested in dollars, then you will have to convert into rupees when you bring the money back. So due to the exchange rate difference, you may run into losses. Sometimes when you purchase the asset, the exchange rate may be at a particular level. When you sell it, the rate might have changed. So because of that movement, if the movement is adverse, it might result in a loss. So that's a risk. So this is affecting mostly for crypto assets as well, cryptocurrency, right? So crypto market is highly volatile. Now we hear sometimes the crypto market collapses all of a sudden because that market is very complex and there are a lot of players. Very difficult for people to figure out genuine currencies, genuine players, traders, platforms, right? Sometimes there are people who manipulate. Sometimes there are fake currencies as well, right? So therefore, you have these volatilities in this market, and mostly this crypto is traded through multiple currencies. Right? When you acquire crypto, you have to use multiple currencies, and when you trade it and when you settle it, so the party whoever has invested need to withdraw the money in their own currency. Then it affects the pricing of final profit or loss. Right. Next. Basis risk. Basis risk. So this happens when you hedge. By the way, how many of you are aware what is hedging? How many of you know what hedging is? What happens in hedging? Any idea?
So it is a mechanism where you try to mitigate the inherent risk of a particular transaction.
Yeah, but what happens there? That's what is important, because here it's a measure or the technique you use to mitigate. But what happens there when you do hedging?
It nullifies it. It tries to nullify the risk factor that is being involved. Say if it's a FX foreign exchange risk, you enter into another transaction that nullifies the risk. Or in other words, say you enter into a forward contract where the risk is fixed, something like that.
Oh. So, in layman's language, we can say, let's say we have a cricket match, right? Sri Lanka versus India cricket match. I put a bet with a friend that Sri Lanka will win. I bet $100. Now I have a risk. The risk is if Sri Lanka loses, I'm losing my money. That's the risk. So in hedging, what happens is you do not touch the basic transaction, your initial investment or the transaction stays as it is. You create another position that is outside the core transaction. It's a different position. The idea of that is to mitigate the impact of the original transaction. Now, in this case, I have a bet with one friend that Sri Lanka will win. If Sri Lanka loses, I'm losing 100. So to mitigate that, I go to another friend and say, India will win. Right? So what happens is, if Sri Lanka loses the match, I'm losing my money with the first guy, but I'm gaining the deal from the second guy. So whatever the loss I am making there, I'm going to recover from the second bet. So that is the mechanism with hedging. Right? So you have, let's say you have invested in another country in dollars. So you have a risk when the exchange rate fluctuates. Let's say if the dollar rate goes down, if rupee appreciates, what happens when you get the return for the investment? There is a reduction because now the dollar has depreciated. So what I would do is, while I have my investment in dollars in one country, let's say I have invested in US, then I borrow from a Singaporean bank or another country, maybe the same country, it doesn't matter. I borrow in dollars. So if I happen to face a loss in the investment side because of the exchange rate movement, that is an investment. Now I have a borrowing in dollars as well. So then the same impact will be there on the opposite side for the borrowing I have taken. Therefore, the impact of that investment is mitigated with this. That is the idea. So you can have hedging for many things. So you can have currency hedging, you can have interest rate hedging, right? So a lot of things you can do that as long as this mechanism is in place as well. So the basis risk is, remember that all this is related to price, right? It happens is your prices vary. That is market risk, right? The basis risk is, if you can remember that hedging, what you are trying to do is you're trying to estimate a possible loss on one side, and then you create another position to mitigate that loss. So that if I lose 100 here, I'm going to recover 100 here, and so that the net impact is 0. The basis risk is when these two amounts do not match. Say, for example, I am losing 100 if the risk materializes. But my mitigating option I have used can only give me 80 rupees. So I'm losing 100, I'm recovering only 80. There's an exposure of 20. So that exposure is called basis risk. Got it? Then the offsetting exposure is similar but not identical. That happens. Right? Say, for example, I told you, I invest in the US market, but I borrow from Singapore. Right? Or sometimes I invest in dollars, I borrow from pounds, not in dollars. So different currency, but pound and dollar generally moves in the same direction, but with a slight deviation. If the fluctuation of these two currencies are not identical, then there could be a gap. So that is what the basis risk is. Right? When the two positions do not mirror each other exactly. Then this is an example, you can look at it. You can even, maybe you can try it. What does it say? UK investor purchase an equity portfolio in the US, the investment itself in dollars. Sorry, this example is this is not basis risk, this example is currency risk, the previous one. Huh? So I have explained it. I don't think we need to work on this, but if you want, you can do this. This is currency risk, huh? Not the basis risk. The slide has come in the wrong place. UK investor purchases an equity portfolio in the US. The investment itself in dollars provides a positive return of 10%. But because the dollar loses 8% of its value against pound, the investor's return is only 2%. That means you are losing it. Then comes the interest rate risk. Interest rate risk. Caused by adverse movements in interest rate. That is, when the interest rate moves in the wrong side. So if you have invested in something and the rates go down, your return comes down. So this risk is therefore mostly the fixed income securities. The reason is your income is somewhat locked, but the market rates move, right? If the market rates move in the opposite direction or in the negative side, you are losing. That's the interest rate. So interest rate movement also affects other assets as well, as you can see, because interest rate determines the price of assets, right? So price of assets is derived from interest rate as well, because you take, what you mean by the value of a share. Value of a share is the present value of future benefits of that share. So then you simply discount it using interest rate and get the present value. That's how you get it mathematically. So therefore, interest rate has an impact on the value of the other assets as well. Right? You can read it, but I don't want to calculate. Look at this. An investor purchases a long-term bond in the UK, hoping to sell it at a profit in the future. Bond prices move inversely to the interest rate moves. That happens when the interest rate goes up, bond price goes down. When the interest rate goes down, bond price goes up. That's how it works. So if the interest rate goes up, the bond price falls. So then for short-term bonds, the change in prices will be literally minor, because short-term the time gap is lower, so that the impact is long-term, the discounting factor is bigger, therefore the volatility can be higher. Right. Then we have commodity price risk. So commodity price, in the sense, here we talk about commodity in the financial market, because the commodities are used as benchmarks and we trade it. We use oil, sugar, wheat, gold, right? These are all commodities, the physical assets. So these commodities are traded using derivatives and instruments. That happens. So then the price movement, adverse price movement affect the commodity pricing. And here, as you can see, when it comes to the commodities, unlike the financial instrument which are just virtual, there are certain other factors that affect the pricing. The market liquidity, that is the availability of sufficient demand, and then decent cost of storage, if it is oil, wheat, or anything you can see. So you need a storage facility to keep them if you deal with large number. So that will cost you. So that cost is also factored when the prices are determined. Then the equity prices. So equity is shares. So the volatility of share price is a risk. When it comes to equity, there are two broader types of income or the returns. One is the capital growth, that is the movement in the share prices, increase or decrease in share prices. So that will have a capital gain or loss situations. If you happen to sell the share at a lower price than what you purchased, it results in a capital loss. Other way around, it's a capital gain. Then you have income, that is dividend. Right? When the dividends are declared by the respective companies, so the investor gets the dividends. So these are the two modes of income. So when you look at equity as an instrument, it has a risk that affects either the capital or the income. Sometimes your capital may be safe, but income is not. Then it affects. Right, so we discussed all the 7 types. Then you have what we call boundary issues. Boundary issues. That means borderlines. So you have different categories of market risk as I discussed. There can be boundary issues between those because there can be similarities or misleading factors. So example, liquid risk could be caused by lack of supply and demand, which also causes price. See, so due to lack of supply and demand, there could be a liquidity risk situation, right? And at the same time, when there is lack of supply and demand, it also affects the prices. So then people tend to artificially change the prices. So then this liquidity risk can result in price level risk as well because of that reason. Then another example, increase in volatility risk will exacerbate price level risk. Again, volatility. So when the volatility risk increases, the price fluctuation is high, then higher the fluctuation, higher the risk. And then it will result in the pricing because the prices can change. Then if you look at interest rate, that has a bigger impact than what we think. Right? Unlike the prices of other instruments, interest rate has a major role in the economy because the interest rate movement has an impact on the national economy, how the rest of the markets behave. So, right, it's a very important point. So it indirectly affects interest rate movement, indirectly affects the overall business performance. Right. So therefore, it can affect all the elements in the organization. So now, as you can see, what happens is when there are boundary issues, that means when you look at one type of a risk, and then it sometimes have the impact of other elements of risk. So it's not easy to pinpoint and say this particular risk is purely coming from this particular cause, right? And sometimes it is not easy to figure out what exactly drives the prices. So probably these are some of the future research to fine tune. Then what mechanisms, what tools are available to manage the market risk? So we discussed just a while ago, we discussed hedging. So hedging is one. Then market risk limits, we'll discuss what these are. Diversification, electronic trading. So these are the four tools we are going to discuss under this topic. Hedging, I will not take time to explain. I have already explained to you what hedging is. So hedging is one mechanism, right? So one thing we need to keep in mind when we use hedging as a tool, so it has to be done with a thorough understanding of the subject, and also because it is a complex thing that involves other instruments, it's important to do it with a proper analysis. You need to have a proper trade-off between the two instruments and the movements. The next one is market risk limits. So we are discussing this broad topic of market risk. So another mitigating is you prevent the risk happening. So you prevent at some point. So for example, this market risk limit is also termed as stop loss limit. Say for example, you have purchased shares in a particular company for 100 rupees. Now, the current market price is 90 rupees. So if you sell it at 90, you are losing 10. Right? So if you keep the share, okay, I don't want to incur a loss of 10, let me wait. Then sometimes it can go further to 80, another 10. Now you are losing 20. So what happens is when the prices go down, mostly the investors or the organizations tend to keep the shares because you don't want to incur a loss. What happens eventually is sometimes if the shares go drastically down, so you acquired at 100, imagine you happen to sell it, you are compelled to sell it at a later date at 40, then you are in trouble. Right? So what happens with market risk limit or stop loss limit is you have a predetermined limit, stop loss limit. Then what happens is when the prices move down, when the loss is materializing, you don't wait till one day the curve comes up or something, right? You have a criteria. So let's say your stop loss limit is 10. If your stop loss limit is 10, the moment your loss becomes 10, you stop trading. That means not stop trading, you realize it. right? So you bought it at 100, your stop loss limit is 10, that means 90. At 90, you sell it 10, incur the loss of 10. But if you keep yourself further, you might end up having a bigger loss. So that's what we do here. Market risk limit is to prevent you going for unnecessary level of losses or risk. You cut, right? You absorb a risk at a particular level and exit. That's why you put a limit. Right. Now, when you look at the risk limit, that means you are setting a target or a boundary. So when you do this, your effectiveness of those risk limits is dependent on the accuracy of risk measurement. That means what is your assessment of the risk, and then you put the mechanism to suit that. Right. Now the problem is when you measure risk, there could be certain issues because we may tend to use oversimplified versions. And oversimplified versions can confuse or might not give the desired result. So what do you have here? Risk limit usually have to be inflated in order to accommodate the errors and uncertainty in the measurement. This adversely affects the potential profit of the firm. What happens? When you use not so good or not comprehensive model, you go one by one. So when your risk measurement level are done using that, it can have implications. What happens is when the risk is seemingly high, you tend to set the targets at a higher level. So when you set it at a higher level, you also have a loss, right? Because you are exposed to higher values. And also, another problem is the traders or whoever the party is involved can exploit the risk, the inaccuracies of risk measurement. What does it mean? That is, when the organization doesn't capture the risk accurately, when the traders know where the gap is, they can manipulate. So that happens when you use a very simple artificial mechanism. Right. Now let us look at some of those techniques. How to mitigate. Diversification. What is diversification? We discussed something earlier. Hedging. What do you mean by diversification? You need to give a technical answer, but at least diversification. What happens there? This is where we have learned in our childhood also we have learned this basic principle. Don't keep all your eggs in one basket. That is diversification. That means you expand into various other domains or products or markets. So what happens there is that when you move away from the same market to another, you are not exposed to the risks and other challenges in that market. The other one is a different one. As a result, your returns, now earlier you have to take the entire return, whether it's profit or loss, from the entire portfolio based on what industry is giving you. But if you have used two industries, you may not get the two industries moving in the same direction. Right? So then there can be some opposite, the two may move in the opposite direction as well sometimes. So then it creates an advantage. Now, the example we generally take in talking about this subject is umbrella and ice cream. Right? So if you have an umbrella shop, you keep on selling this, the chances are you will not sell umbrellas during sunny days because people might need umbrellas mostly when they have the rain. Then you have a risk. Sunny days, umbrellas won't have a market. So you start an ice cream business also. Umbrella and ice cream. So when it rains, you have more umbrella sales. When there's sunshine, you have more ice cream sales. So it will mitigate the fluctuation of the umbrella thing or the risk that they take. That's what happened with diversification. With diversification, you combine different assets together and then manage, because the returns of these assets might go in different direction. Then the overall return will be stabilized. We'll be discussing some of these techniques later, how you combine it and how do you know which way to do this. And there's something that has popped up in the recent past with the technology, electronic trading, right? So we don't have manual trading anymore, right? So you have electronic trading platforms and then you deal with it. So what happens with this electronic trading, there are tools available. Some are very high, very expensive, right? They read the market and analyze and predict using these techniques, sometimes AI kind of things. But you get the results. Now, there's one advantage this electronic trading gives over and above the rest, in particular, is the speed advantage. Because it's faster than a manual task. It's faster than a manual task. Now, there's another thing that came up with this electronic trading thing, because now you can deal at a higher speed, process a lot of data, and then you can derive possible price iterations. So this one, high frequency trading HFT, is a portion of that electronic trading. What happens there is that this technology enables you to trade very large volume of transaction within seconds, because it's automated. You are not using manual systems, right? So this high volume of trades take place with the systems. So that's how this is used in the derivative market or the financial markets. Then, if you look at when we discuss different risks, you can recall we discussed credit risk, now market risk. Likewise, you have different risk, operational risk. So, in organizations, depending on the magnitude of this risk, right? Depending on the magnitude of this risk and depending on the necessity to manage it separately, you need separate teams. But most organizations, you have only a obsessed team. Sometimes it's credit risk team, but you generally don't have teams for other functions, right? So that happens, right? In Sri Lankan market, I don't think all the institutions, they have separate teams for credit risk team, market risk team, operation risk team. I doubt whether we have that kind of mechanism. So we have one sometimes, right? So therefore, for an organization to manage it, you need to have this overall dedicated mechanism. So what do you have in an efficient market function? Ownership. First, you need to have a policy, and there has to be someone who is owning it. That means a dedicated team. Then proactive involvement. That means you need to figure out what's going on, whether it's relevant, whether it's connected to the marketplace, etc. You look at it. Then you need to have a defined escalation procedures. What do you mean escalation procedures? What is escalation procedure? Any idea? Escalation procedure.
You set up certain limits based on certain transactions, and when a dealer reaches those limits, you report it to board subcommittees or to different levels. So
Yeah.
ultimately, the board. Yes.
Ultimately, more. So escalation means always you are communicating to the next layer. Escalation is not dissemination, no? So dissemination is different. Dissemination is sharing the information among parties. Escalation is communicating the matters to the upper levels, next level, right? So depending on the situation, depending on the magnitude of the risk factor, okay, you need to decide whether the escalation is required. And then you have a policy in organization generally with the amounts. If we have a situation or a loss or an EMIS for up to this level, you have to escalate within this many hours to party X. If you have an issue beyond 500 million, let's say you have an internal target to say, okay, let's say beyond 500 million. And then that is very significant. You go to the next layer. So you have a kind of, okay, value, the criticality, and who would be the escalating party. It clearly establishes in organization, and then you can make that escalation smoother. But there you need clearly defined targets and the mechanism. Independent validation. Independent validation, you get a third party or an expert to validate. Right? Then you can use value at risk model. Value at risk means you are setting the limits, right? Set limit. Ensure that value at risk is not used alone. Now, it's an important thing. Why do you think that value at risk should not be used alone? What could be the reason? So value at risk is it calculates or predicts the loss.
So because there could be limitations in value at risk,
What kind of?
if it's a historical simulation, it assumes that the history will repeat. So it might not. Likewise, so stress testing will, using other mechanisms, will reduce that limitations.
Yeah, what happens is with value at risk, you simply estimate your loss limit or value. It's a mathematical calculation. But you are making this calculation for future, right? Always is future, right? When you do that, there's no guarantee that whatever the results you get out of this calculation is a final version, right? It can vary. So, because we are dealing with future, it's always recommended or good. You look at different scenarios. That's why stress testing, scenario testing. Stress testing is you change some parameters and see whether we are still feasible, right? Scenario analysis is in a stress test, you take one variable at a time to change the situation and everything. Then comes scenario analysis. You're not just changing one parameter or anything. You change the scenario. That means it can have multiple variables being changed at a given point in time. So stress test one variable at a time you test. Scenario, you change couple of variables based on a concept. Then what it says is when you do the VR model, always back it up with a stress testing or scenario analysis so that you have seen the different variations. The independent daily monitoring of risk utilization. That is a control mechanism. There has to be a mechanism to monitor. Right? Mechanism to monitor how the risk is being utilized. Now here you can see the market risk management function has slightly broader areas than what you look at, right? But what we generally see or experience in yours. I think I have told you at the beginning of this course, don't try to relate what happens in your organization in answering this. So as much as possible, get the overall idea, right? And then different risk components, elements, and then you connect them. So this is an overall idea here because as you can see, it's not a complex thing. It can vary, but here the idea is to give you a basic version of that mechanism, how it works. Then comes market data. This is a new area, right? Market data. From this slide onwards, we are getting into another area that is not pure risk management. That is, we are learning some tools that support the risk management. What I suggest is now that it's 8:15, next part is more than Risk in financial services. It is to do with statistics. We are going to learn some statistics, some tools based on what we discussed up to now, and then that is relevant in our next discussion as well. So here we are going to learn how these calculations are done, statistical calculations are done, ratios are done, which will help you in improving the rest. So let's take a break now. So maximum now it's almost 8:20, almost 8:20. So let's get back around 8:35, 8:40. Yeah, then we'll continue the statistics part. Right, I think everyone is back. Let's continue. Let me share the screen. Right. Market data. So this segment, as I told you before I break the session, we are touching the data management, how you deal with market data. So what if you go back to the topic that we are discussing today? So we are trying to manage the market risk, right? We're trying to manage market risk. When you try to manage the market risk, it's something probably to do with elimination or mitigation. So to do this, we need to be able to analyze and identify some trends and parameters for us to make our decisions. However, one of the things we need to understand that when we deal with the market, you cannot analyze the entire market as a whole because it's not practically possible to deal with large amount of data. So what we have to do in that case is to use a sample or identified set of data, and then from that we have to read the market, or we call it infer. We have to draw inferences from the sample about the population, about the total picture. So this topic, what we are trying to do is to do that part. That is, we are trying to now understand how we use sample data to get an idea or predict the market information, no market level, to get an idea, right? So the sample, we know population is the entire set of data we want to get an idea about. Right. So we need to learn some terms before we get into the nitty-gritties or the calculations. Some of you may have gone through this, maybe having some idea about this, but for the benefit of all, let's go through one by one. Population and sample. Population is the set of all possible states of a random variable. but all possible state. If you take something, right, a variable, all possible state is the population. That means all the components, the entire thing. Sample is a subset, a representation of the population we extract, on which we perform the calculations. Now, when we deal with sample, you need to know three things, right? What is the typical value of the sample? Typical value is the representative value, right? Representative value. Say, like, for example, if we want to, let's say, in a school, you have A-level classes, 10 A-level classes in a school. We want to identify the height of the students. So that's the variable, height of the students. We take 10 students representing the entire A-level classes. And then we need to first get what is the typical value, what is the representative height of these students. Second, what is the variation? Let's say I can say the height is 5 feet. Then when you look at the sample, everyone will not be 5 feet, right? So some may be 4 feet 3 inches, some may be 5 feet 5 inches. We can be. So what is the fluctuation or deviation from the typical value I have taken? So that as an average, that is the dispersion. That is called dispersion. That is the deviation from the central value or the typical value. Then these two parameters we extract from the sample. Let's say in that example I've taken from the 10 students we select. But our idea is not to comment about the 10 students. Our expectation is to comment or get an overall idea of the total student population in the A-level classes. So we need to then identify how far the sample mirrors the population. So how representative the sample is, so that we can comment on the population based on the findings of the sample. Right? Those are the three things we need to establish when we talk about this. Now let's go little deeper to understand some concepts. So there's this concept we all need to understand, which is called the normal distribution. Normal distribution. Normal distribution represents the behavior of the data or the variable values in a typical setup, right? So if you look at in the setup, right, the world, how things are present. Let's say if you take people, you have a small number of very high people, right? Sorry, the taller people, right? Maybe above 7 feet, 6.5, whatever. And you have another smaller percentage of shorter people. And then you have a large number of people between these two, that some maybe between 5 feet to probably 6 feet. So you have a higher volume in the middle and low volume in the extremes. So the normal distribution curve It's a bell curve. That's how it works. So what is in the middle is what we call central tendency. In a normal distribution, all the central tendency measures sit in the middle. Then we have the deviation from the central point, either side, plus or minus. That's how we interpret it. So the central tendency measure gives a single number or value representing the data set that we use. That's a typical value. So when you look at this central tendency or the typical value, there are three different measures we have. Mean, it is very simple terms, mean is average, right? Average value. Then median is the midpoint. If you arrange the values in ascending order, right? Starting from the smallest to the largest, whatever the midpoint, this is a position, right? This is a position. Whatever the midpoint item is called the median. Then we have the mode. Mode is the most frequently occurring value, right? High volume, highest volume. Right. Then mean. We'll go one by one. Mean, I told you, is nothing but the average. Very simple. Right? So if you have a data set, you simply add all the data points together and you divide the total by the number of occurrences, and then you get the average. That is mean. Very simple, no need to think. So we use these symbols sigma to denote the total. X is the value, different values, and then X bar, you can see on the left hand side, X bar is a symbol we use to denote the mean. But N represents the number of occurrences or items. Right. Median. I told you median is a position number, right? You arrange the data points in ascending order, right? Ascending order, and then identify the midpoint. Midpoint, and that value is called the median. So if you take this, you have altogether 9 numbers here. So the fifth item is the midpoint. So the median is 12. Right? Whatever the value in the midpoint is 12. What happens if we have even numbers? So here we have 9 numbers. What if we have 10 numbers? Right? When you have 10 numbers, you take the 5th and 6th point divided by 2. Right? That average we take as the midpoint. Then comes mode. Mode. Mode, I told you, the mostly occurred or the most frequently occurred number. It's a volume, right? But with mode, unlike mean and median, there can be situations where you have more than one mode. So let's say you have 10 items, you can have number 3 2 times. You can have number 6 2 times. Others single. Then what happens? 3 and 6 2 times. So both have the same volume. So then we call it a binomial distribution. Right? Binomial. Sorry, bimodal. Bimodal. 2 modes. You can have trimodal, 3 modes, and 4. Or you can have many more than, then multimodal. Likewise, with mode, we have a problem. If you don't have a clear demarcation for one item, you have a problem when you have many modes, right? That's a practical issue. Now, these 3 central tendency measures represent a set of data, and how do we figure out which measure to use in a given situation? Now, if you go back to the definitions, what each of these measures talk about, mean is the average. So in most cases, mean is used as the preferred central tendency measure because it's easy to figure out. You just have to take the total and divide by the number of items, and then it also represents, because this mean represents all the numbers in a set of data, because you have to take every item, add all of them, and average it so that it's a contributory figure. Everyone has contributed to this number. But the problem is extreme. You have outliers, right? When you have outliers, the mean get distorted. For example, let's say you have 1, 2, 3, 4, 6, 8, 9, right, and 100. So we have something like this. What happens? What is the total of this? 3, 6, 10, 16, 24, 10, 33, 100, 133. Divided by 1, 2, 3, 4, 5, 6, 7, 8. What do you get? 16.6. Now, you get an average of 16.6. But if you look at the numbers, right, out of 8, 7 numbers are less than 10. Just one number which is very high, outlier. Now, this is the problem with mean. when you have an outlier or extreme case, the average get distorted. It doesn't represent the real dynamics or features of the data set. So that's the problem with this. We have to be mindful. If you use average or mean as a central tendency measure, we need to make sure that there aren't any outliers or unusual numbers, extremes in the data set. Right. Now, when you say mode sometimes gives a better idea. That is the commonly used value. So, in other words, majority. When you take the votes, when you take the choice of people, yeah, if you have 10 people, what is the view of the majority? So, mode is the majority vote, right? So, what the majority says, the spirit. So, if you think the majority view is more representative in a given set of data, you go for it. So, in that case, it doesn't have any impact on the extreme values because it picks the majority. But the problem with mode is you have two main problems with mode. One is there can be situations where you don't have a clear majority. Every number in the data set occurs only once. So you don't see any number more than once in no mode. That's a problem. And also you have a situation, as I mentioned earlier, there can be multiple modes in a given set of data. Right? Many items occurring at a high frequency, right? Similar levels. Other than that, mode is a good one. But the problem is mode is about the volume, number of occurrences. It sometimes ignores the mathematical values, right? The quantitative values. Therefore, mode is mostly suitable when you deal with qualitative data, right? This it's about the frequency, right? So what frequency? You just have to count the instances, irrespective of the values given. Then we have median. Median is considered the most robust measure because it doesn't have the impact of extreme values because you ignore the extremes. You take the midpoint, right? And also, it is not affected by your data trend, right? Then you have skewed data. What do you mean skewed data? Skewed data means it's not normally distributed. Let's say normal distribution occurs like this. Skewed data is you can have something like this. Like it's against the normal distribution. Sometimes you can have high volume of high values, right? And low volume of low values. But normal distribution, you have a low volume of high values and low values and high volumes of average values. So skewed curve is like this. Skewed can be this as well, right? You have high volume of low end values and low volume of high end values. So median, there's no issue because even if you have this situation, in the median, you arrange the data in the alphabetical order, you take the midpoint. Right? So it's a fair representation of the given data. That's why technically, right? Practically we mostly use mean, the first one, as a central tendency measure. But technically, median is more robust. It's robust, right? It's stronger. However, as I told you, we need to look at the situation and play it accordingly. Right. You can see how this when is skewed, how the data set is moving. Right. Now, measures of dispersion. I told you earlier we discussed central tendency measures. Now we look at the deviation. Here what happens is we look at the central point and we look at the deviation from the central point and take an average of that. Right? We used several techniques there. Range and interquartile range. We'll discuss what. Right. Quartile deviation. Then variance, standard deviation. Let's take one by one. Range. This is a very basic one. Right? This is a very basic one. So here what we take is, in a given set of data, you arrange it in the ascending order. And then we identify the lowest. You don't need to necessarily arrange it in the ascending order, because as long as you can pick the data, it's fine. You take the lowest point and you take the highest point and take the gap. Right? That value is what we show. You can see here. So let's try to find out the lowest point. That's the lowest point. What's the lowest point? Two, right? Lowest point is 2. Then we take the highest point. 30. Right? 2 and 13. -2, 11. So this is the answer, range. But the problem is similar to our previous case, mean this has the impact of extreme values. Let's say we had 100 as one number here, then you take 100 minus 2, 98 as the range. So then you take the gap, right? And the other problem is you only take the two ends, right? The lowest and the highest, and you ignore the rest of the numbers in your calculation. But as a number value, you take it, but it has this weakness or drawback. Then we have this interquartile range. This is a solution. This interquartile range is a solution for one of the drawbacks we had in the previous case, that is the impact of extreme value. We are trying to address that here. What happens here is that we break the data series into quartiles, right? 4 quarters, segments. And then you ignore the upper end and the lower end, and you take the endpoint of the first quartile and the endpoint of the third quartile, the 2 points, and take the gap between the two. Right? Take the gap between the two. And then take the midpoint like median. Right? That is the point. So 5% to 7%. That is the gap range. So you eliminate the impact coming from extreme values. Then we have quartile deviation. Right? So interquartile range is the gap between the first quartile and the fourth quartile, the difference, or the third one, the range. Quartile deviation is 1/2 of that gap. You take Q3 and Q1, right? And then take the gap. So you can see the numbers here, a random set of numbers. We need to figure out what the lowest, the third quartile is. Right? This is arranged in order, right? So you can take the first quartile. So how do you take that? What is the first quartile number? How many items here? We have, if you count it, 13, right? And then you need to get the from this 13 number, you take the midpoint. Q2 is the median midpoint. That is the 7th point. 7th point is what? 7th point here. That is the midpoint. Right? Then you have the lower end and the upper end. You can divide the set into two pieces, lower and upper. So you have two sets. Here you have left hand side, you have 6 items. And the midpoint of this is the first part, that's Q. Right? What is that? This data set. Midpoint is this 60. Upper point, this range, midpoint is 83. Then you take 60 and 83. What is the gap? And that divided by 2. Right? 83 minus 60 divided by 2. You get 23 divided by 2, that is 11.5. That is the answer. Quartile deviation. Right? Clear? Any question? Okay, no questions. Then we have variance. Variance, we have a calculation there. What happens is, you have to first calculate the mean, what we discussed in the previous one, the average, right? Mean of the given data set. And then you have to get the gap between the mean and the rest of the data. Say, for example, if you have 2, 4, 6, 5, 8. You have 5 items here. So what is mean at the total and divided by 5? 6, 12, 17, 23. That 23 divided by 5. So how much? What's the value? 23 divided by 5 is 4.6. 4.6 is your mean. The next step is you have to get the gap. That means you have to deduct 4.6 from every number, right? 2 minus 4.6, 4 minus 4.6, 6 minus 4.6, 5 minus 4.6, 8 minus 4.6. So you deduct, right? So you don't need to worry about the plus minus here, right? Whatever you have to get the gap. Then you square it. Then your plus minus issue anyway gets sorted, because if it is a minus figure, minus into minus plus. So the answers here all will be a plus figures for all the numbers, but square it. Right? Then you take the average of this. That is called the variance. That is called the variance. Right? Hope it's clear. So you can see this example. If you want, you can try this, right? But I will not spend time in doing this. You can get it. If you want, you can try it, right? I will not spend time. Then the next is a standard deviation. Standard deviation is nothing but the square root of the variance. Very simple, right? Whatever the answer you get for variance, get the square root of that, you will get the standard deviation. So here, the same thing is given in the formula. So whatever you find inside this square root symbol is the variance. And the answer to that is variance. And then when you take the square root, you get the standard deviation. Now you can see there is a statistical formula we need to use when we do this. When we work with a large number of data, that is generally in statistics, large number of data means more than 30 volumes, right? We go with n to divide the number. But when the number of data set is less than 30, smaller, we go with the sample deviation model where you take n minus 1 as the divider. You divide it by n minus 1. If you have 13 items, you divide the answer by 12, not by 30. Right? So that's a statistical rule that we use, which has been proved. You are not required to find how it is proved and all. Right? Right. Then we have some more terminologies. Right? Some more terminologies. Distribution analysis. Confidence intervals. Normal distribution, we discussed that. Fat tail distribution. Right? So, what do you mean by distribution analysis? Distribution analysis is very simple. We have the data. Statistical means that we have obtained from a set of samples. You take many of those and then you have a prediction about what the future trend of that would be, right? Based on a probability. So normal distribution is one of those. There you have taken all the possible scenarios that can take place within the behavior of a normal distribution, and then you have a shape, bell curve. By using that, you can solve problems. You can solve other issues where you feel that the data set is a normal distribution. Right? If the data set is located as a normal distribution, you can solve those problems with that. This normal distribution curve, we have seen that there's an interesting thing about it, right? Now see, in a normal distribution curve, assume all the data, a population is inside this, it captures everything. If it is a normal distribution, you can see this symbol, right? You can see this symbol here, plus 1 sigma. plus 1 sigma means from the mean points, the midpoint, 1 sigma away. The sigma is a standard deviation, right? Standard deviation measurement is in sigma. So 1 standard deviation, if you add to the mean, right? So let's say your mean is 6, your standard deviation is 2. So when you add 2 to mean, that means 8, right? 6 here, it's 6 value. And you minus 2 from this is the negative side, right? Then that is 4, right? 6 minus 2. So the idea here is that, let's say this is 6 and 2 represents the, let's say, number of members in the family, a large family, including large, right? Your grandfather's, grandmother family. So 3 families together. Let's say, for argument's sake, living members in the family in a given population. On average, they have 6 people in the family. That's the idea of 6. And they have noted the deviation, 1 standard deviation, 2 up and down. Now, as for this normal distribution interpretation, how you interpret this is 68% of the data set, right? Let's say if it is people in that city, 68% of the people in the city as family members between 4 and 8. That is how you interpret this. Right? 60% of the population is within this range. Then 2 sigma level, that is median, so mean plus 2 sigmas, 2 standard deviation, that is 2 into 2, 4. 6 plus 4 is 10. This is 10. Then 6 minus 4 is 0. Sorry, 2. 6 minus 4 is 2. This is 2, this is 10. Now the meaning of this is standard deviation. Now it's 2 standard deviation away from the mean. So if I take this area from this point up to this point, this entire curve, right? 95.5% of the total population in that city is within this range. That means 95% of the population in that city has family members between 2 and 10. Yeah, that's the idea. Then 3 standard deviation. 6 plus 6 is 12. 6 minus 6 is 0. So 99.9, so 99.75% of the population has family members between these two. That's the idea. Now in a normal curve, you don't capture 100% because this curve doesn't touch the line here, it goes still. Therefore, that's how it is designed. Now that's how you interpret the normal distribution curve, right? You can see what proportion of the data set is within that given range. And based on the data provided to you, you should be able to calculate the data points or the range and then say, okay, this many number is within this, right? So you can use this for any purpose. Let's say, right? Let's say income, right? Income, your mean income is 100,000 in that village or in that company, what, 100,000, right? 100,000 and standard deviation is 20,000, sorry, 10,000, let's say 10,000. So what do you say? If the standard deviation is 10,000, mean is 100,000. So 100,000 plus 10,000 is 110,000. 100,000 minus 10,000 is 90,000. What does it mean? 68% of the population or 68% of the people in that company or whatever the selected area, right? 68% of them have income between 90,000 to 110,000. Then tool standard deviation, that is 120 and 80. What does it mean? 95.5% of the population in that company has income between 80,000 to 120,000. Right? That is how you interpret it. I just took some time to explain you this. You need to understand this concept or technique, because when we work on calculations, you need to apply this with the calculations in getting a particular answer. Right, now the time is up, 9:30. So I will not complicate you too much. We learned somewhat technical stuff today. We learned measures of central tendency. We learned measures of dispersion, right? And now we are still here. And now we are discussing about the distribution curve, right? Distributions, no normal distribution we discussed. And there are a few others, a couple of slides. I'll finish those slides next day before I start the new topic. So any questions or clarifications on what we discussed? Right. So if you don't have any questions, that's it from my side. We'll see you next week with a new topic. After I'm done with the balance part, we'll start a new topic. Good night.